Perfect.
Recording. Okay, cool.
Yep.
Hey everyone, how's it going? Alex Sabio here, married father of four. I love short-term rentals, and that's my niche. I started investing in hotels, and I love helping healthcare professionals invest in real estate. So that's me.
Hey everyone, my name is Savannah. I am a registered nurse. I'm up in Northern California now, just left beautiful Los Angeles. I have been nursing for almost 10 years, started investing in real estate beginning of 2020. I own apartment syndications and help a lot of healthcare professionals invest passively in real estate through syndication deals. So I'm really happy to share and educate and collaborate with different healthcare professionals in the space. And today we have Armond on, who's going to talk specifically about lending for nurses. I know we get a lot of healthcare professionals asking us specifically about qualifying for loans and different things like that. So happy to dive in today. So with that, I'm going to kick it over to Armond.
Hello, everyone. My name is Armond. Been in the business for a decade, and I am going to share my screen in just a moment. Savannah, could you give me access as an admin to be able to share?
Oh, Alex, can you click
Or Alex?
over?
Oh, are you able to do it now?
Yes. Okay, cool. So we're going to do share. Cool. So everyone can see the screen?
Yes, looks great.
Beautiful. So real estate lending prescription for nurses, right? So my name is Armand. Again, I've been in the business for over 10 years. I've helped 1,000 families get into homes and achieve home ownership, whether it's through investing, buying multiple properties. And I'm a family man, so I love families. I love working with families, and in general, that's what I do. So we all know owning a property is the smart thing to do, but most of us get intimidated by the process and we just don't know how to start. So what I'm going to do is I'm going to basically go over lending in a nutshell, and more particularly for nurses, right? So whenever you're looking to buy a house, unless you have the cash to do it, you need some type of loan. Now, no matter who you go with or who you talk to, at the end of the day, they're going to ask, well, they're going to circle around three metrics. It's called debt to income ratio, the credit score, and your down payment. So the first one, debt to income ratio, this is what determines your purchasing power. It's all based on income, right? So I did a little quick Excel math here. It's fun, so follow me here. Let's say you're a nurse and you're on a straight salary, making $10,000 a month. Oh, my apologies, $10,000 a month. The way the banks lend you purchasing power for mortgage is based on your debt to income ratio. So in this case, if I'm making $10,000 as a nurse, right? The bank will say, okay, approximately half of that is a budget for a mortgage plus credit expenses. So in this case, you'll see I listed it as PITI plus A. That's your mortgage. What it stands for, it's an acronym for principal, interest, taxes, and insurance. And should you happen to buy in a condominium or a project where there's an HOA fee, there's an association cost as well. So if I'm making $10,000 a month, my budget for a mortgage is $5,000 a month. Now, let's say I go and lease a brand new Porsche for $1,000 a month. Naturally, that reduces my purchasing power to $4,000 a month. That's basically, in a nutshell, how the debt to income ratio works. So if you're making, the higher the income you make, the bigger of a purchasing power you could qualify for. Now, the next one's credit scores. So a lot of people think like, I need an 800 score. You don't. I mean, ideally, you get the best possible terms and rates and programs, but you can buy a house with as little as 580. Whether you own a home or not, financing is available down to 580. Now, of course, we're not going to just leave you stranded with a 580 score. What we'll do is, as we kind of go through the pre-approval process, figure out what the best options for you are, as soon as we see the credit report, I'm going to personally give you the tips you need to increase your score. Or if needed, I'll connect you to the credit specialists that are available that I work with that can build your score. So when the time comes that you're ready to execute and write an offer on a property, be it 1 or 2 months or 3 months or a year, your score is increased and in the best possible position to give you the best terms and rates. So we covered income, we covered credit, now's the down payment. So there's a lot of misconceptions. I need 20% to buy a house. You don't. As long as your intentions are to live in the home, there's options where you could buy a house with as little as 3 to 5% down, depending on your credit score, depending on the program we go with. Now, if you're looking at multi-units, a 2-unit plus does require 15% down. So it does get a little more aggressive when you start looking at larger units. But you've heard it before. Well, how is it that people are buying 4 units with 3.5% down? So there is a way. You can buy a house, 4 units with 3.5% down. The catch is it has to pass what's called an FHA self-sufficiency test. Essentially, those 4 units, right? You have to live in one of them. So let's just say 1, 2, 3, 4. As long as all 4 units on paper, once we do the appraisal, show that the market rents would cover the mortgage payment, it passes. So you're okay. So sometimes it might mean that you might have to increase that down payment a little bit, maybe to 5% on a particular home, because it's just not showing enough income to break even, to qualify to be able to do it with very low down payment on a multi-unit. Now here is where nurses have issues. So nurses have irregular income. So I work with a lot of nurses, and that's how we met. I met Savannah. It's because of I specialize working with nurses, right? So I work with all the different types of nurses, traveling, RNs, you name it, we work with them. So the challenges are you have irregular income, right? The next is student loans. So a lot of nurses have student loans, or they work multiple jobs. They might be traveling. They might work for 2 or 3 different employers, or even they have non-traditional hours. So they work night shifts, and by the time they get off of work and they're ready to just figure this out, no one's available to pick up their phone call, or they just don't have enough cash for the down payment. And then finally, you might move to a different city to get a higher paying job, or just any kind of work in general, and the homes around you just are too expensive. So we're going to go through those and kind of dive into each one. So what I did was I'm going to cover the income again. So income, right? So nurses have either a base salary, they'll have overtime, shift differentials, bonuses, different types of bonuses, holiday pay, on-call pay. This is all just normal stuff to all of you guys, right? But when you walk into a bank, let's say you walk into a big bank, right? So the big bank, what they'll see is they'll look at gross total numbers. And when you get into underwriting, they'll either get confused or they'll cause issues. And basically, here's how I break it down. And this is what I do for all my clients. So if you look at the bottom or the top, I've listed 21, 22, and 23. Let's say you are a nurse. Your gross salary in 2021 was $150,000. In 2022, it was $150,000. And 2023, you're pretty much on track to hit $150,000. So when you walk into a big bank or just any general lender, they'll look at it and they'll say, yeah, you make about $150,000. Let's get you pre-approved and get you into house. A few weeks might go by when we're in escrow, and then they'll come back and say, sorry, we just can't do this loan. We noticed you had a lot of overtime. You had a lot of shift differential. There was bonus pay. There was holiday pay. We don't understand that income. We can't do it for you. So the way it's done, right? So the way income is calculated is pretty straightforward. What we do is we itemize everything. So whatever your base salary is currently will give you all of that income, okay? So if last year you were at 115, and let's just say, forget what it says here, let's say it was 200,000 this year. As long as you can show a hire letter or some kind of proof that your base pay is what it is, we'll give you that. Now, here's where it gets tricky. Overtime is averaged for year to date plus the past 2 years. So let's say this year I hit 20,000, the year before was 25, the year before was 20. As long as it's increasing or steady, we'll average it out. But if it's something like on-call pay, where in 2021 you earned that income, 2022 you earned that income, and then 23 you just didn't, I can't give you that income. So what we do is the moment we start working together, we'll do a pre-pool, we'll reach out to your employer and get request what's called a verification of employment breakdown, and it itemizes this, right? Otherwise, when I look at your pay stub, all I see is on the left side, basically all I see is the year-to-date totals. I don't see the itemization for 22 and 21. Your W-2s just show gross whole numbers. So it's important to break this down, reach out to your employer and collect this. And if you have multiple employers, we need it across the board. So in this case, I was able to break out that I was able to pull out 146,000 income from someone's salary that would mirror this. Sure, it wasn't the full of 150, but remember, they lost that on-call pay. Maybe they just changed roles, or the employer switched that payout and they're just not doing on-call pay anymore. So it's important to, if you have overtime or bonus income, you work with someone that understands how to break this down. So each line item has to be broken down over 2 years plus year to date. Now, here's where traveling nurses run into a lot of problems. I had a client that I put this for little notes for myself. She worked at one of those med hospitals where it's aircraft, the helicopters that come and pick up in emergency cases, like AirMed, CareFlight. And she had multiple jobs. She had job 1, job 2, and job 3. But the problem was there was a gap in employment. So here, let me break it down. So she had one steady job as a nurse from January 1st, 2019, and she worked up until now, right? So that's usable income. But she tried also using her other job that she's currently working at. So when I looked at the timeline, I looked at job 2 and I said, oh, well, you started just a few months ago in May. Yes, you're currently working now, but what's the history behind it? She told me, well, for that job, she had a gap of employment because her second job, right? There was a gap of employment. So she worked another job from October 21st for a year until October 2022. And then she took about a 6-month or 7-month hiatus and then started working again. Most underwriters, when most banks will look at this and say, we can't use that extra income. So if there's 10,000 here plus another few thousand here, this immediately is disqualified. Well, we have ways of explaining it to underwriting, whether we sit down, explain it. I took a leave of absence for a maternity, or I took leave of absence for school. I studied and I got additional degrees and I level up my position. Now I'm a full RN instead of an LVN. So it all depends. It's case by case, but it's important to understand this. So if you're someone that has multiple jobs, you need to talk to someone that breaks it down and itemizes and understands it so we can use all of your income. Otherwise, most banks will just look at this and say, sorry, this is disqualified. We're only using this 10,000. And now you're kind of just pushed to the side and you don't qualify for that loan. So it's important to figure out your income from your different jobs. Next, now I get it. A lot of you have different hours and you work at nights or day. I'm very flexible, right? So this is my practice. This is my business, and I want to accommodate everyone. It's not to say I'm going to pick up a phone call at 1 a.m., but what I do want to do is, if you are serious, you are looking to get pre-approved, or you need someone to hold your hand, more than happy to. So as long as you take an application and you get me financials and I see a level of commitment, more than happy to set up a time, whether it's on a weekend or an evening. We can meet up locally or a coffee shop, or to set up a Zoom call. Or alternatively, we use technology. It's a software called Loom. Every client gets a presentation where it's me talking, explaining things, walking through payments, out of pocket, what it took to qualify. So we use a lot of technology, right? The next one, the biggest concern nurses have is cash to close. Where am I going to come up with this cash payment? Well, if you remember, the down payment, it only takes about 3 to 5% to get into your first home. So $1 million home, you only need about 40 to 50,000 out of pocket. And if you don't have those funds, you can either give funds from family member. So in reality, your first home or any property that you plan to occupy, keyword occupy, can be 100% gift funds. So a father, a family member, a cousin, brother, mother, sibling, spouse can gift the 100% of the purchase down payment to buy a home. Naturally, you want to talk to an accountant to make sure that there's no tax implications, but there's lifetime tax gift inclusion amounts. I want you to talk to CPA, but it's roughly about, I think it was 12 million for a lifetime. So there's not really any kind of tax implications you would run into, but talk to your CPA. Now, what other people can, what else you could do is borrow against your 401k. So if you have a healthy 401k retirement account, typically what you do is you would go and withdraw it, but the concern is taxes and the implications, right? So if you're not over the age of 62, you get hit with all the taxes, the early withdrawal penalty, but you can actually borrow against it. So if I have a $100,000 401k, I look up what's called terms of withdrawal. And in the terms of withdrawal, it'll state the funds can be used for the purchase of an owner-occupied home or emergency use. So what you do is you call the advisor and say, hey, I have this much money. I'm looking to buy a house. Can I borrow against it? And the money you're borrowing, there's no penalty. There's no cost to it except for the interest that you're paying backed into it. So it's your own interest. So if I borrow 100,000 and my payments are $400 or $500 a month, and a portion of that is interest, that goes right back into my 401k. It doesn't get burned away. So you can borrow against your 401k to put money down to buy a home. Next is a HELOC. Some of you might own a home. So if you have a house, the smart way to get additional cash to buy your next property, or other people like to call it the BRRRR method, is a HELOC. You tap into the equity, you get a second line of credit. We don't touch your first. So let's just say you bought a home in 2022 or 2021 and you have a low rate and you don't want to touch it. We don't have to, we leave it alone, but we do tap into equity using a second position loan called a HELOC. We could borrow it and use those funds to buy a home. Now, there is one other option, it's called a bridge loan. And this is in a situation that you want to sell your home to buy this next home, but you don't have the cash available to do it. we do what's called a bridge loan. So we tap into that equity from home A while you're about to sell it, and then use it to buy your home B, the new home. And then the bridge loan kind of covers that down payment, and it gives you a sufficient amount of time to pay off or sell that existing home. So that is pretty much lending. I know we kind of went fast through it, but that's pretty much lending in a nutshell. The key thing that you want to understand is the debt to income ratio. It's income. It's all based on income, and your purchasing power is based on what you can show monthly. So I wanted to kind of take a pause there and see what kind of questions we have so far.
Armand, what are you seeing? Are you seeing a lot of nurses who are interested in buying an investment property after they purchase a single family home? Or what is your insight or opinion into doing either one before the other?
As far as like buying an owner occupied property versus investment.
Correct.
So yeah, so if I'm in a position, right? So let me give you an example. If I'm renting a house and my rent is very low, naturally I'm thinking, well, if I buy a home, I'm going to pick up a $5,000 or $6,000 mortgage, and my quality of life is very similar because my rent might be low. Again, this is case by case. I'm thinking Los Angeles, you might be in an area where your mortgage might be less for your rent. But typically, your first home should not be used for an investment, and here's why. You want to buy your first home as an owner-occupied using 3 to 5% down, because it gives you that coupon to do it as a low down payment. You're living in it, right? After you live in this home for 12 months, you could turn around, rent out this home, and buy your next home as owner-occupied. Whereas if you come to me and say, Armand, I'm renting, I just want to buy an investment property. The first thing I'm going to say is, well, the investment minimum down payment is 25%. So if you're putting 25% down on a house, that ties up all your cash. It's better to just buy owner-occupied, take those 25% you would have had, and just diversify and buy property A as owner-occupied. Live there for a while and rent it out. Buy property B as owner-occupied. Live in it for a while and rent it out. And keep doing this until you've built up a strong portfolio.
Hey, Armand, Alex here. So I have a travel nurse. He just texted me right now. His name's Richie. And so he makes really good money as a traveler, but he took a significant pay cut. You're talking like 50% pay cuts to be a staff nurse in Colorado. And he's looking for some advice here, because what he's wanting to do is he's wanting to invest into and buy an investment property. What's your advice to him? Because he's thinking of going back to his traveler so he could make double the income.
Yeah, it all depends on the numbers. So if I'm at a high paying job, it all depends on okay, so it's two components. Were you being paid as a W-2 salaried or a Schedule C sole proprietorship, right? So some nurses get paid as a self-entity, as a 1099. So let's focus on W-2. If I was a traveling nurse and I had multiple jobs, I was making a ton of money, naturally what happens is if you go to a job that pays less, the banks see that, right? They see the history and they see that new job. So what they'll do is they'll say, okay, we're going to give you only the income that you're earning now. So I can't tell you, hey, go back to your old job and make that extra money and just to buy a house. The smart approach is, well, what is your current income? What is that reduced income? Let's break it down, figure out what you qualify for. And if it's not enough, let's have that conversation. Maybe it does make sense to go back to the previous job where it was a higher salary and then buy a house at that point. So until you know the numbers, you can't make a decision.
Got it. Thanks.
Of course. Now, go ahead. I was going to tap into the Schedule C portion of it. So let's say you're a traveling nurse and you're paid as a 1099. On your tax returns, there's a page called Schedule C. You'll make all the income in on line one from all the different jobs, right? Let's say it's 500,000, 3, 4, 500,000. But then you have cost of goods, traveling, advertising, marketing expenses, and then that net income shows $45,000. Well, we have to use that net income. So if you are a traveling nurse, or if you're any kind of nurse that you're in a position where you are sole proprietorship, we go off of that net income. So what we would do is we would look at your tax returns. I would tell you what you qualify for. We put a plan together. And if it's not enough, we plan for the year after. So again, 2024 is around the corner. You could do an early filing. We could sit down with your accountant, review how you file your taxes, and I can tell you, look, these expenses that you're doing are hurting your purchasing power. So talk to your accountant, back these out. Let's show what you're actually earning and qualify for a home loan. So there's different paths and avenues to take.
Yeah, Armand, you're kind of touching on this right now, like kind of the length of process in getting financing for housing. I know for me, when I came into the space as a semi-impatient person, I was a little bit taken aback by how long sometimes this process takes. Like, how long are you really working with people through this process of getting them qualified for a loan? How long does it usually take for your average client?
So surprisingly, it can be pretty quick. If I were to talk to someone today, I ran their income and it's pretty straightforward where there's no reason to reach out to the employer. It's basic salary. There's no overtime we have to look into. In theory, I could get them pre-approved on the spot, run credit, get them a pre-approval letter. They could write an offer that night, get it accepted, and we can close in 3 weeks and they have themselves a house. So to answer your question, we could do it as quick as 3 weeks to the point where you have a key. But being realistic, it does take some work, especially if you're more complex. So I want to say, if you can do an application, we look at everything in about a few days. So 2 to 3 days, we can probably pull off everything, reach out to all employers. Again, we have to work together. If there's a lot of employers, I've worked with nurses where they have a Rolodex of W-2s and we have to dig in and ask all the employers, hey, give me the last pay stub. Let's understand what all the itemization of income was. That takes about a few days and sometimes about a week. Once all that comes together, you're set and then you can start shopping. The next concern is, well, you pulled my credit, and what if I don't buy a house in the next 3 to 6 months? Remember, when we're kind of going through the process, we're not looking to rush and pull credit for no reason. We're only going to pull credit once we've identified the income and know that a loan is doable or purchasing can be done. So once I see that sufficient income, because again, you're telling me I have X, Y, Z as my expenses. So is when we pull credit. Once we pull credit, that report's good for 3 months. But being realistic, again, we're not looking to just help you out now and just leave you on a stranded island. We're going to be communicating throughout the process up until you buy a home. If it takes a year or two, by all means, we're not looking to rush you into a home. We want to make sure you're making the right decision. It's not a car, it's a house, right? So when we pull credit, that credit's good for 3 months. However, after 3 months, I'm not going to go and click refresh, pull new credit. I'm going to leave it alone. Now, let's say a year passes by and I have a stale credit report. We'll hop on a call and tell me like, hey, did you apply for anything? Did you run your credit? If you didn't, then you're good. Just go write an offer on the property. You'll be fine. Once your offer is accepted, we'll pull credit, we'll confirm the details. And this minimizes the inquiries. Whereas some people just like to just run it all the time and it can impact your FICO score.
Armand, you touched on something earlier, borrowing from your 401k. The one thing I can tell you is I am awful at planning. I'm very spontaneous, and sometimes these investment opportunities come to me like this. So borrowing from your 401k, do you recommend I do it like earlier and just have it sit? Or, if I'm borrowing the 401k for a down payment, does it need like seasoning period in your account to be able to use those funds?
Great question. So it can be done pretty quickly. It's important if you have any inclination, if you're on this call, if you have any idea that you want to buy a house, why aren't you calling your HR and finding out about your 401k? So my suggestion is find out as soon as possible what you can borrow from it. Don't make the withdrawal, leave the money alone. Just find out what it takes to borrow the money. Then when we borrow the money is the moment we get into escrow. So typically when you're buying a home, there's what's called an escrow period. It's on average 30 days from the moment you write an offer and it gets accepted to the point where you get the keys. So the moment your offer is accepted, we'll work together. We'll talk to your HR advisor. We'll find out what the dollar amount you can borrow. We'll get the withdrawal going. It usually takes about a few days, about 5 days. Once the funds hit escrow account, basically the intermediary account, the settlement account, it's ready to go. So we have those funds basically used. So to answer your question, no seasoning is needed. You can do it at the time of purchase or prior. My suggestion is find out now and don't touch it until we're ready to use it.
Armand, we had a question come in from someone. Can you talk a little bit more about second home loans? Dive into that
Yeah.
a bit.
Yeah, totally. So second home loans. So again, a lot of the viewers are all around the country, so I can't really give you specifics, but I'll be hyper local to where I'm at. I live in Los Angeles, right? So typically, someone that's in Los Angeles, when they're looking to buy a second home, they want to buy it by the beach. They want to buy it in Big Bear or up north in Napa Valley. So second home loans can be done. They do require a larger down payment. On average, it's 10 to 15% down because the bank knows this is your second home. They're not going to give you that coupon where you could buy it with 5% down. So what happens is your income has to be strong enough to service property A, which is the one you live in, plus property B. However, again, this is done during the consultation. We might say, well, why don't we just not do a second home if you don't qualify? Let's say the income's not strong enough. We could do it as an investment property. Therefore, what you do is that property you're buying, we do a market analysis and we say this home, you're buying it for $500 or $1 million, it's going to generate $5,000 a month in rent. We could use a portion of that potential generated rent to help offset that income. So now you can buy those two properties. So it's very rare we do it as a second home. It can be done, but your income has to be strong enough to service both property A and property B. Typically, a lot of times we either do it as investment, or the client genuinely wants to live in that new home, and then they'll rent out their existing home and move into that next home.
Hey, Armand, since we're talking about vacation homes, because I'm a short-term rental investor, and a lot of short-term rental investors use the 10% vacation home loan to purchase these properties. I heard that they added a ton of fees to them within the last year or so. Can you speak a little bit about that? Or are those fees going away? What's the deal? Or is that loan product just completely dead?
And that's why I kind of said we don't do the second homes much because, okay, so let me take a step back. Remember earlier I told you there's debt to income ratio, there's credit, there's the down payment, there's the three metrics of qualifying for home loan. Who's coming up with these rules anyway? So when you're looking to buy a house in America, there's two entities, Fannie Mae and Freddie Mac. They're two government-sponsored entities that buy and provide housing loan programs for all across America. So they sat down, they came up with all these different guidelines. So now, when you're looking to buy a house, they're the ones that come up with the guidelines. So sorry, I got a text over here and it threw me off track. Remind me again the question so I could jump back into it.
Is the 10% vacation home loan dead because
Yes,
they've
okay.
added a lot of fees, or is it
Got it.
even still there?
So Fannie Mae and Freddie Mac have what's called loan level price adjustments. So if I'm buying a home, right, the interest I get is adjusted by the credit score, the down payment, the type of home I'm buying, whether it's a single family, whether it's owner occupied, a second home, or investment. So what they did was they're trying to they're trying to allow more first-time home buyers or owner occupied properties to persons to buy homes compared to investors. So they've added large pricing hits to second homes. So you are correct. To give you an example, the national average for a 30-year fix today is 7.875. Now, that's for an owner occupied, whereas a second home, it's 8.75%. So there's a huge pricing hit to buy a second home. It's almost as expensive as doing it as an investment property.
Armand, we sometimes talk to a lot of people who are wanting to invest in real estate and they're having a lot of trouble saving up for a down payment. I know you touched on kind of some different ways to tap into different capital. How do you recommend, or what resources do you point someone to who's really having trouble saving up for that down payment?
Is this for owner occupied or investment?
Either or, but probably more owner occupied.
Right. So really it comes down to just coming up with that initial cash payment, right? So no one's going to buy their first home, and I take that back. It can be done where you buy your first home and it's the dream home. However, the market has appreciated significantly. So the average home is very expensive. So in LA's market, the entry-level home is $1 million, and you're not getting much for that home. So $1 million home takes about $30,000 to $50,000 down. You don't need to save up the full $200,000 down or 20% to buy this home. So for someone it's their first time, they're trying to figure out where they come up with the savings, look at these options. These are pretty much what's available to you. So you can either, again, if you're in a position where you have the cash, you could sell some stocks. You could get funds from family members. So for example, if you're getting married, instead of asking for gifts, you could set up, there's a few websites, I could put it in here, the link afterwards. It's called Gift Funds for Homes. So it's a website, you register, you say, look, I'm buying a house, I'm getting married, please donate money to this account and it'll help me buy a home. So your family members can all put money into this pot where you can use it towards the purchase of a home. You could borrow against your 401k. So really, you do have to come up with that initial down payment, but it does take about 20 to $30,000 down. Now, again, thinking creatively, you might not have just enough. You might have just enough to qualify with the down payment, but again, there's closing costs. So another way you could do it is you can actually write in an offer, hey, look, seller, I want to buy your house. I'm going to do 5% down for this $1 million home. That's $50,000. Typical closing costs are another 15 to 20K. I don't have those funds. Hey, seller, can you help me? I'll give you $1 million for your house, but can you credit me $15,000 for those closing costs? So now my out-of-pocket expense is that $50,000 and not more. So there's different strategies to be able to kind of come up with the cash, but a buyer does need to come up with at least 3 to 3.5% down for that first home.
Hey, Armand, got another question here. 3.5% down. You just touched on it to get that primary home. How long does someone have to live in it until they convert it to, let's say, a midterm rental? Because we have a lot of travel nurses that are actually part of our group that would be interested in doing that.
Technically speaking, it's 12 months. So by contract, you have to live there for 12 calendar months before you can rent it out. If you do it prior, you have to advise the servicing bank, hey, I'm going to turn this into a midterm or long-term rental. Please, know this. They'll adjust your interest rate. They'll qualify you for a higher rate, and it starts messing up your mortgage payment. So ideally, you want to occupy the home for 12 months, live in it, and afterwards you could rent it out. Short-term or long-term.
Another question here, because I just did my taxes and I have so much write-offs here where it shows that I pretty much have zero income because I have all this depreciation. And I'm thinking about buying a primary home. Am I in trouble here, or am I not going to be able to purchase a home because it shows that it looks like on paper that I don't make any money?
Yeah, great question. So on paper, you might not show that money. However, you truly do qualify. So remember, Fannie Mae and Freddie Mac are the ones that came out with all these loan programs. There's alternative loan programs where it's private investors, and they have what's called non-qualified mortgages. Basically, it's non-traditional mortgage. So the most popular is what's called DSCR. What we do is, instead of those 3 metrics of income, of credit, and down payment, we ignore your personal income. All we're focused on is the property. So the metric is, as long as the property's potential rents cover the mortgage payment, you're qualified. The budget's unlimited. You just naturally have to put the 20% down. So for someone that's not showing income, the down payment does get a little harder. It's 20%. The next possible program, and this is more for someone that's has a business account or also owns a business, we have a bank statement program. So we could use personal accounts too. So it just has to be one account, either business or personal. We look at 12 months of deposits. So now, instead of looking at your tax returns where you have all those write-offs, we're actually diving in and figuring out your true income. So let's say you had a 10K, 12K, 30K, $1,000 months. All these deposits, we tally it up. We apply a servicing ratio to it, right? So we know, depending on your line of work, there's going to be expenses. So we can't give you all that income. Typically, it ends up being about 50% of it. So 50% of those deposits act as income, and the rest of the formula comes back into play where we use that income to qualify you for mortgage, which is here, right here. So for example, not to confuse you, because this is a lot of numbers. Say my bank statements show $20,000 a month for 12 months in a row, and I'm a nurse. I have general expenses. Me as the bank will come back and say, okay, you make 20K a month. I see deposits. I'll give you half of that as an income. So now that 10,000 lands here, and then we give you 50% of that as a budget for mortgage plus expenses. So if you have a lot of expenses, there's avenues to buy a home. Typically, you do need at least 10 to 20% down to buy a home.
Armand,
Go ahead. Go ahead, Scott.
Talk a little bit about what's been happening in the industry as a whole over the last couple of years. I mean, I started in it in 2020, so I've seen it change quite drastically from that time. And overall, in terms of like volume of loans that you're doing, like what are you seeing out there?
Yeah, so a lot has happened in the past few years. I like to compare, I think 2019 was the last year that we can kind of see true volume. After that, it was artificially increased. So we had the pandemic. The Feds did what's called quantitative easing. Because everything was shut down, the economy came to a halt. So to encourage spending, banks lowered the federal funding rate to 0%. So that means Chase, they don't use all their funding, if you fund their money, right? They do what's called fractional lending. So if I'm a big bank, I have $1 million in assets, I could lend 100 million, but naturally I don't have all that money. So I go to the Feds and I'm like, hey, give me money so I can lend it out. Well, during those 2-year period, they dropped it down to 0%. So the banks were borrowing money at zero. In return, conventional loans dropped down to 2%. So now you have fire being added to the market. Rates are really low. People are qualified for higher purchasing power. Then on top of that, the government was giving out a lot of, and again, this is very local to Los Angeles, a lot of PPP or business rescue loans. So there was a lot of incentives to kind of keep businesses alive. Sadly, what people did was reuse those funds to buy homes. And it artificially increased sales prices. So $1 million home after the pandemic was $1.5 million homes, because you have low rates, people with all this extra cash just dumping and buying properties. It raised the market. So now you fast forward to March of 2022, the Feds came out and said, look, hold on a second. We did the wrong thing. We lowered rates too low for a long time. Inflation's skyrocketing. It reached 9.5%. So we need to slow down the economy. Let's bump rates. So they did 13 rate hikes in total. And every rate hike, the conventional interest rate went from 2.5%, 3.5%, 4.5%, now to about almost 8%. So what's happened locally is there's a lot less transactions. A lot more people are sitting on their homes, not wanting to sell because they have a very low rate. Unless there's a particular reason they want to sell or they have the force to, there's less homes on the market. So really, if you're a person that's looking to buy, I know a lot of people say this, date the rate, buy the home. It's kind of true, right? So if you want to buy a home, there's limited amount of inventory. Unless some kind of act of God comes in, home loans for the past 15 years have been secured by very strict underwriting guidelines. You're not going to see a lot of foreclosures. You're not going to see bad loans written. So unless something big happens and more properties hit the market, home prices are going to continue to appreciate. So while transactions are low, there's still a lot of people buying home. So, for example, I'll tell you, I have 6 transactions right now active, escrows of people buying homes. That tells you, like, wow, one loan officer has 6 people he's helping. Now multiply that by 100,000. People are still buying homes, and their thought process is, wow, the payment sucks, it's expensive. But hang on a second. If I wait, right? Let's just use $1 million again. If I wait till the rates come down in a year or two, well, so is everyone else. It comes back down to supply and demand. Everybody else that's waiting on the sidelines is going to flood the market with a lower payment. And now that $1 million home is going to be outbid. So on an average home in Los Angeles, there's about 5 to 10 offers written. In the peak of the pandemic, it was about 70. Well, if the rates come back down, what do you think is going to happen? Those 5 to 10 offers are going to become 40 or 50 people. So it's just going to drive up purchasing power, prices of homes. So really, my suggestion is, this is across the board. If you are looking to buy a home, figure out what your finances are, buy within your means, and lock it in. And then later down the line, take advantage of the refinances and lower that overhead cost. But the sooner you buy, in the long run, you will win. The only person I tell they should reconsider is if they want to buy a house for a year and they want to move out. But we don't know what's going to happen in a year. Does it make sense to buy a home? Are you going to appreciate? You'll probably break even. Or, unless you're a savvy investor and you're going to flip the home and make money, sure. But if an average person just wants to buy a house and they're going to plan to live it in about 7 years, no matter what happens, that long-term, that property will be worth more than what you pay for it.
Hey, Armand, I'm going to ask the $1 million question that everyone wants to know, and I get asked all the time. Where are these damn rates going? What's your take on this? When are they coming down, or are we going to be stuck here for a little bit? What's your take on here? Obviously, you don't have a crystal ball, but we want
I
to
was
get your
rubbing it,
opinion
right?
here. Yeah.
So there is one more rumored Fed hike coming up in the next month. Once the Fed meeting comes together and they sit down, they revisit the economy, they're probably going to raise it by another quarter one more time. They're projecting next year to lower it 2 times. Again, this is all projections. Me personally, I think 7s and 8s is the new norm for the next 6 months. And then by the time election comes around, historically speaking, is when you see rates come down when it's right around the election. So I think maybe Q2, Q3, we might see rates get lower. How much? I don't know. In the 5s, God willing, I don't think so. Maybe 2025, we'll see something in the 6s or 5s. But for the next 6 months, expect the rates to be about 7 or 8%.
I got one more question, and I guess we'll wrap it up because I've heard you kind of touch on this a little bit before, that the government's kind of steering more towards homeownership versus the investors. They have a lot of fees there. Are there any other programs out there? I know when I started investing about 20 years ago, there were these 80-20 loans where it just flooded the market with all of these people because they didn't have to put down as much money. Are there other programs like that to help investors or primary home buyers right now?
Not investors, but for owner occupied, yes. So here's how they work. So remember, the typical down payment is 20%. You don't need to put that. You could put 3% down. Matter of fact, I encourage to put as least amount of money down as you can, where it keeps your payments comfortable. So the programs that you're thinking of are the down payment assistance. It depends on the county you live in. The government does a consensus on the average median income. Every zip code gets a dollar amount. So in Los Angeles, my city, Glendale, the average median income is $84,000. So these down payment assistance programs, here's what they say. They piggyback off of the 3% down loan. So they'll say, okay, you need to put 3% down. We'll give you the 3%, plus we'll give you a little bit extra for closing costs and to cover all those fees. So if you're buying, for example, a $100,000 home, you essentially are buying it upside down at 110,000. So you're financing 110, but you're not putting any money into it. To qualify for these, your income, so whatever that calculated income is, so if it's 10,000 a month, 5,000 a month, whatever it is, that it has to be less than the average median income. Here's where the problem comes in. In a densely populated area where the homes are $1 million plus and the average median income is $84,000, if you're below that, 80,000 is not going to qualify you for $1 million home. So it doesn't work in densely populated areas like Glendale, Los Angeles, and metropolitan towns. Where it does work is kind of the outskirts, like think of Falun, California, think of Barstow, where the average median income is 70,000 and the homes are 300,000. We do those in-house. We can help you guys out. So if you're living in an area or looking to buy a home in a more rural area or where the home prices are more affordable and within certain means, basically under 600,000-700,000, there are certain programs where they can help you with the down payment. It's important to understand what it takes to get there, right? So I don't want you to blindly go buy a $100,000 house and be in debt for 110. It's important to understand it and know how the terms and program works before you execute. But absolutely, there's many programs that can help a first-time home buyer get into the house. We just had one pass where it was huge. It was called the Dream Program. And instead of giving you the down payment, they kind of do an equity share. It just ran out. It might come back this next year. We'll let you know. But the way it worked is they gave you 20% to buy a house. So no money. Well, 1% of money was required from the borrower. The rest, this fund gave you the 20% to buy a house. So again, if you're buying $1 million home, they're fronting 200,000 basically to buy a house. The catch is, whenever you do sell the home, they wanted a portion of that equity, of the profit you made. So you have to pay back the original 200 plus a portion of the profit you made. In the global scheme of things, that's a win because you now have a property you wouldn't have had before, and all this equity. Without this program, you wouldn't have been able to do it. So it made sense. It ran out in about a week, and they're in talks trying to bring it back. But that was a very popular one. The other ones just help you with a down payment of 3.5% down. But it's important to understand it because it's not just one loan. It's about 3 loans tied behind it to cover closing costs, to cover the down payment. all those little fees, it helps it cover it. So it's important to understand it. But yes, again, there are programs to help owner-occupied first-time home buyers to get into a house with down payment assistance.
Wow, so awesome. It's such great detailed information. And I think a lot of people, when they jump into real estate investing, I think one of the most overwhelming parts is you feel like you need to know it all and you don't know it all and you don't even know where to go and who to begin to learn some of this information from. So a lot of great details in that. Thank you so much. We're going to put the recording up on both of our YouTube channels so you guys can catch it there. But Armond, where can people get a hold of you to get more information?
Absolutely. Work with me. So on any social media platform, you name it, just type in The Giant Lender, you'll find me. You can write me an email at Armond@Ohan Group. You can call or text my cell phone number, or you can visit my website, getmeprepproved.com, which forwards you to my company's website, Beyond Lending. So it's just a hyperlink, of course, but getmeprepproved.com, that's where you can do your application or reach out to my cell phone.
Awesome. Well, thank you so much. Alex, any parting words?
No, that's it. Thank you so much. I think lending is on everyone's minds right now. And that's kind of what's holding people back. But I think if the numbers work and it's cash flows, I think real estate's always a long-term play. And I think you'll be okay in the end.
Absolutely. Thank you both. Thank you all. I appreciate you all, and we'll be in touch.
Thank you,
Awesome.
guys.
Sounds good. Have a great night.
Bye.